The UK has been shocked by the passing of Queen Elizabeth II.
A few moments ago, Buckingham Palace announced the death of Her Majesty Queen Elizabeth II.
Both emotionally and economically.
Her Majesty Queen Elizabeth II has died.
The world's fourth largest economy is experiencing its greatest economic crisis since 2008-2009. This comes on top of the Bank of England's inability to effectively reduce inflation and a cost of living crisis. The situation in the United Kingdom threw global finance markets into disarray. But how did we end up here? To begin with, the UK economy has performed pretty poorly since the Great Financial Crisis. Growth and productivity have been disappointing, lower than many of its competitors and far lower than the post-war trend rate. For many years, the pound has been steadily declining. It has already plummeted by about 20% against the dollar and 6% against the euro since June 2021. Debt has risen due to a sluggish growth since 2007 and is anticipated to rise further as demographic trends push. Inflation has reached levels not seen since the early 1990s as a result of rising energy prices. Furthermore, it risks becoming more ingrained in the economy, despite nominal salaries falling behind inflation. However, the greatest blow to the economy came on September 23rd, when former Prime Minister Liz Truss's Chancellor of the Exchequer, Kwasi Kwarteng, announced the UK's largest tax cut in 50 years, projected to be worth almost £45 billion over 5 years. The so-called mini-budget suggested tax cuts for the UK's richest earners, as well as a rollback of corporate tax rises and an increase in national insurance costs, all of which are set to take effect next year.
Is expected to be around £60 billion. We expect the cost to come down as we negotiate new long-term energy contracts.
In an effort to promote home purchases, Kwarteng and Truss's plan also eliminates the stamp tax, a fee on land sales in England and Northern Ireland. When the market opened on Monday, global markets reacted by selling off UK-backed assets, causing the pound to fall to $1.03, its lowest ever value versus the dollar, before rising later in the week. Investors overwhelmingly opposed the new economic strategy, called Trussonomics, after Ronald Reagan's supply-side economic policies of the 1980s. Truss and Kwarteng defended their choice to cut taxes for some of the richest Britons and established special incentives for corporations, including tax cuts and regulatory rollbacks, claiming that the tax cuts will drive greater economic investment. It's a 21st century version of trickle-down economics, taking place in the middle of global inflation and soaring oil prices. The mini-budget was imposed against the acknowledged reasoning of most major economists, and without the usual political checks and balances. On September 8th, Truss fired Tom Scholar, the Treasury's permanent secretary and a longtime civil servant. Scholar's dismissal was generally viewed as a political ploy that not only cost the government a well-respected technocrat at a tough economic moment, but also weakened the impartiality of the UK civil service. According to a National Institute of Economic and Social Research review of the plan, the government also requested that the Office for Budget Responsibility not give any independent analysis of the proposal. This eroded trust in the government's capacity to pay its obligations and generated concern about the economic credentials of a new prime minister who entered office following a bitter leadership election in the governing Conservative Party. Previously, the Bank of England has considered selling bonds in order to reduce the volume of money in circulation and therefore bring increasing inflation back to its 2% objective. This is known as quantitative tightening and is a tactic utilized by the majority of developed economies. Instead, following the mini-budget, it had to immediately shift direction. It delayed the tightening and resumed quantitative easing and bond purchases, vowing to buy up to £10 billion in gilts every day to address a related pension fund issue. It's unclear what type of strategy the administration will employ next. A debt-cutting strategy from Hunt and the new administration, led by Rishi Sunak, should reassure investors about the UK's fiscal soundness, but it's unclear if this will be accomplished through more taxes or reduced expenditure. Some data suggest that hiking capital income taxes would be better for the economy than decreasing public expenditure or raising income taxes. Sunak has stated that his government would have to make some very difficult decisions, but he has also guaranteed the public that he will behave compassionately while dealing with the country's profound economic crisis. Sunak, Britain's first Indian-origin prime minister, has promised to correct the mistakes committed by his predecessor Liz Truss, which resulted in a black hole in government finances and market upheaval. According to a readout from his first cabinet meeting, he started the discussion by stressing that economic stability and financial sustainability would be at the heart of his government's objective. According to the readout, the 42-year-old former chancellor emphasized that the government would have to make some very difficult decisions, but the government would also act with compassion, protecting the most vulnerable, and would continue to seek long-term growth. It is said that Chancellor Jeremy Hunt emphasized the need for economic stability and credibility as the foundations for all other initiatives. Long-term issues for the UK include stagnant growth and a lack of productivity. And if the incoming administration solves existing challenges by raising taxes and slashing expenditures, together with increased interest rates from the Bank of England, the economy will suffer much more. Many nations are experiencing comparable problems to the United Kingdom, which is contributing to the current gloomy global economic picture. Most nations expected interest rates to rise after a protracted period of historically ultra-low rates, a process known as the normalization of monetary policy. However, a dramatic rise in inflation as a result of Russia's invasion of Ukraine and pandemic-era supply chain concerns has prompted most central banks to tighten monetary policy even further by raising interest rates more quickly. These rate increases and policy tightening methods by central banks have the potential to cause major financial and budgetary turmoil. Already, the U.S. Federal Reserve's shrinking of its balance sheet from a height of $8.97 trillion in April 2022 has led the dollar to rise more than 10% in the previous 6 months. This has posed difficulties for emerging market currencies and major currencies such as the yen, pound sterling, and euro, which have declined significantly over the U.S. dollar. This has increased inflationary pressures, notably in the Eurozone and the United Kingdom, but it also impacts sovereign bond rates, putting economic stability in these nations at risk. Many people's borrowing costs have more than doubled since August. However, in order to combat increasing inflation even more, central banks will wish to reduce their balance sheets by selling bonds. The combined amount of the 4 major central banks' asset purchasing programs is around $26.7 trillion. With a poor global economy and other financial vulnerabilities, this will be a difficult exercise for the global economy. Indeed, such tightening will raise the cost of government borrowing even more, posing huge problems, particularly for heavily indebted countries and those still paying for pandemic-era assistance, such as the UK and Eurozone. The United Kingdom in particular is coping with a shift in the global economic center of gravity away from its economy. In less than 2 decades, the UK's GDP has plummeted from being larger than China's to being around 9 times smaller. Furthermore, the pound no longer has the same significance as the US dollar, which means that financial markets will penalize it harshly if it deviates from the peg. Even with a new Prime Minister largely regarded as a steady hand, the new UK government faces a difficult challenge in reigniting global investor confidence in its economic stability. Recently, the Bank of England warned that the UK economy might enter its longest recession since the 1940s. Furthermore, the third quarter decrease compares with a 0.2% increase in France and Germany and a 0.5% growth in Italy. The European Commission has warned that increasing interest rates and high inflation are likely to push the Eurozone into recession in the fourth quarter. It now forecasts inflation to peak at 8.5% towards the end of the year. Nonetheless, the Commission anticipates Eurozone GDP growth to continue positively between 2019 and 2024. In contrast, the Bank of England predicts that the third quarter will mark the start of a 2-year recession in the United Kingdom. That would be the longest depression since World War II, surpassing the dip that followed the 2008 global financial crisis. However, the central bank stated that any GDP decrease in 2024 would most likely be minor. The British Chamber of Commerce's David Barrier, head of research, said in a statement that Friday's GDP data solidify the picture that the economy is moving towards, if not already in, recession. Weak economic growth adds to the strain on the UK government as it strives to regain investor trust. Jeremy Hunt, the finance minister, overturned most of her proposals in his first few days on the job and is anticipated to propose significant tax increases and expenditure cutbacks in an effort to decrease debt in the medium term.